Let's get some analysis on this now. Crossover to the Bank of England, where George Buckley, chief UK economist at Deutsche Bank, is standing by to speak to us. Thank you very much for joining us today, Mr. Buckley. So the BOE is expected to keep interest rates on hold, but as we were hearing there in the last minutes of the MPC meeting, it emerged that Andrew Sentence made a push for an interest rate rise, the first in almost 2 years. What do you think is the right way forward at this point?
Well, I think they need to keep interest rates on hold today and also keep the quantitative easing total unchanged at 200 billion. I think there are, over the next few months, going to become a lot more splits on the committee. Our view is being pushed out. We now think the Bank of England won't tighten until the start of next year. But still, by the end of this year, we'd expect to see a few members voting for rate hikes.
They should keep interest rates on hold, that despite inflation expectations accelerating above the government's 3% upper limit?
Well, it's all about offsetting the balance of risks, and yes, there are some concerns about inflation, but a substantial amount of inflation being over target is largely because of taxes. If you strip out taxes, inflation wouldn't be 3.5%, it'd be more like 1 3/4. So I think that's worth bearing in mind. On the other side of things, we've had a lot of concern about what's been going on in Europe, and that will be weighing on the minds of policymakers as well. So it's all about balancing those risks.
Now, you talk about balancing risks, and one issue under consideration by the MPC will, of course, be how fiscal consolidation, cutbacks in government spending will impact on economic growth. Is that something to be very concerned about at this point?
Well, back in the May inflation reports meeting, the Bank of England governor said that fiscal tightening, additional fiscal tightening, might not have any big impact on their central growth forecast. And if anything, it might actually reduce the downside risks to economic growth. And that's because you're not seeing a big blowout in yields, which might have been caused by doing nothing on fiscal policy. However, that said, government spending is worth quite a substantial amount of GDP. It contributes about a quarter of overall GDP. So if you stop spending, it will have a negative impact on economic growth. The other issue, of course, as I mentioned, is that lower interest rates will actually do exactly the opposite.
There are those saying, though, that it isn't perhaps the right time to be tightening monetary policy, or rather launching a fiscal consolidation program when you have weak growth, rising unemployment, economic turmoil in some of the UK's main trading partners in the Eurozone.
Well, I think at the very least the Bank of England needs to hold this month and wait until they get the August inflation report forecast, because that's going to give them a much better base to judge whether it is an appropriate time to tighten policy. I suspect by next month that won't be the case. I suspect it might be towards the start of next year, possibly towards the end of this year, but certainly we're looking at 6 months' time at least before the Bank of England raises rates, in our opinion.
George Buckley, chief UK economist at Deutsche Bank, thank you very much indeed for joining us. We do appreciate it.